It is a slaughter. There is no other word for it. What you are seeing on your screen right now is not a correction. It is not profit-taking. It is not a technical pullback. This is a demolition, a controlled demolition of the metals market. As I hit record on this camera, gold has just smashed down through key support. It is hovering at levels we have not seen in months. Silver? Silver is being taken out back and shot. We are watching a vertical drop, 4%, 6%, 8% in a matter of hours. I'm refreshing my terminal every 30 seconds, and every time the page loads, the net worth of the retail sector has shrunk. Billions of dollars in long positions liquidated. Hundreds of thousands of accounts margin called. Thousands of traders wiped out completely. And it is not stopping, not slowing down, not finding support. It is accelerating. Gold just cracked 4,500. Silver is trading under 72. Every technical level that was supposed to hold has shattered like glass. Every bounce that should have triggered is getting sold into oblivion. This is not normal selling. This is not organic price discovery. This is forced liquidation on a scale we have not seen since 2020, maybe since 2011, maybe ever. I have been watching markets for over a decade. I've never seen anything like this. And the data I found last night, the data I am about to show you, explains exactly why this is happening. And it is terrifying. Welcome to the hidden economy. If you are new here, I expose what is really happening in markets while mainstream media is too scared, too lazy, or too compromised to tell you the truth. Subscribe right now because what you are about to see is the kind of analysis that will not appear on CNBC. It will not appear on Bloomberg. It will not appear anywhere else. If you find value in this video, smash that like button. It helps the algorithm show this to more people who desperately need to see it. And right now, a lot of people need to see this. Now let me show you what they do not want you to know. Here's what caused this bloodbath. The weapon is called a margin hike. And right now it is being deployed with surgical precision. When you trade futures, gold futures, silver futures, you do not pay the full value up front. You put down a deposit, usually around 8 to 12%. Now here is where it gets dangerous. The exchange, the CME in Chicago, has the power to raise that margin requirement at any time. No warning, no vote, no appeal. They simply announce margin is now 15%, or 18%, or 22%. When that happens, you suddenly need more cash. Not next week. Not when your bank transfer clears, immediately, tonight, before the next session opens. If you do not have that cash sitting ready in your account, your position gets liquidated automatically. The exchange sells you out at whatever price exists at that moment. And when everyone is getting liquidated at the same moment, the price at that moment is catastrophic, rock bottom, the worst possible exit. One margin hike is survivable. Most traders keep a buffer, some cash on the side for exactly this scenario. But 2 margin hikes in a week? That hurts. 3 hikes? That bleeds you. 4 hikes? 5 hikes? What about 8 margin hikes in 8 weeks? That is not survivable. That is not risk management. That is extermination. That is financial warfare against long positions. And that is exactly what the CME has done. I went back through 20 years of CME data. I pulled every single margin adjustment for gold and silver. Here's what I found. 2022, 2 margin hikes the entire year. 2023, 3 margin hikes. 2024, 2 margin hikes. 7 total hikes across 3 years. That was normal. That was how the system was supposed to work. December 2025 to February 2026, 8 margin hikes, 8 weeks. More hikes in 2 months than the previous 3 years combined. Christmas Day hike, New Year's weekend hike. Every time traders thought they had caught their breath, another hike. Every time the bleeding stopped, another cut. And then came the kill shot, January 13th. CME switched to percentage-based margins for silver. This is the part that should scare you. Under the old system, margins were fixed dollar amounts. You knew exactly how much buffer you needed. Under the new system, when silver rises, your margin requirement rises automatically. The trap tightens itself. Now, the higher silver goes, the more cash you need, even if you do absolutely nothing, even if you do not touch your account. This is not risk management. This is a mechanism designed to trigger forced liquidation at exactly the moment when longs are most vulnerable, during a rally. And they did not stop after Friday's massacre. Monday morning, another hike, then another one midweek, the 8th hike, while traders were still bleeding from Friday, still trying to fund their accounts, still on hold with customer service, another hike. Each hike triggers forced selling. Forced selling pushes prices down. Lower prices trigger margin calls on other traders who were not even affected by the original hike. Those traders get liquidated. Prices fall further. More margin calls trigger. More liquidation. More selling. A death spiral. By design. That death spiral is what you are watching right now. Gold, 4,500. Silver, 72. And falling. But here's the part that kept me awake last night. Here's the part that made me realize this is not just one exchange protecting itself. This is something bigger. This morning, same day as the CME hike, the Shanghai Gold Exchange also raised margins from 20% to 26% on gold, on silver. CME in Chicago, Shanghai in China, 14 time zones apart, same day, same action, same direction. I need you to understand how extraordinary this is. America and China agree on nothing. Trade war, technology sanctions, Taiwan, South China Sea. They argue at every international meeting. They slap tariffs on each other constantly. Their central banks are actively competing for global dominance. But on precious metals margins? Suddenly they are moving in perfect lockstep. Suddenly they are coordinating. That is not supposed to happen. Exchanges compete with each other. They do not coordinate attacks on their own customers, unless they are both scared of the same thing. And I think I know what they are scared of. 356 to 1. That is the ratio of paper silver to physical silver on the COMEX. For every single ounce of real metal sitting in the vault, 356 ounces exist on paper. 356 paper claims chasing 1 real ounce. This works fine when everyone settles in cash. Nobody actually wants the metal. They just want to speculate on price movements and take their profits in dollars. But when people start demanding physical delivery, when they actually want the silver they are legally entitled to, the math explodes, and people are demanding physical delivery. In numbers I have never seen before. In the third week of January, 33 million ounces of silver walked out of COMEX vaults. Not traded, not rolled over, physically removed, loaded on trucks, driven away, gone. 26% of everything they had in 1 week. 4 years ago, COMEX held 430 million ounces of silver. Today, 113 million. 74% has vanished, and it is accelerating. First week of January, 7 million ounces left. Second week, 12 million ounces. Third week, 33 million ounces. The exit is not slowing down. The exit is a stampede. Who is taking the silver? Not retail investors. You and I cannot move 33 million ounces. Moving that much metal requires logistics, trucks, armed security, bonded warehouses, insurance policies. This is institutional money. Manufacturers who need silver for production. Sovereign wealth funds, central banks, the smart money. They are draining the vault, and they are doing it before March. Here is why March matters, and this is critical. March futures represent 528 million ounces of promised delivery. That is how much silver has been promised to traders holding March contracts. The vault has 113 million ounces. Read those numbers again. 528 million ounces promised. 113 million ounces available. They have promised almost 5 times more silver than physically exists in the entire COMEX warehouse system. First notice day is March 27th. That is when every trader holding a March contract must declare their intention. Cash settlement or physical delivery. If just 22% of contract holders demand delivery, the vault is completely empty, not tight, not stressed, empty. What happens when the 23% shows up asking for their silver? What happens when legal contracts cannot be fulfilled? This is the nightmare scenario. This is what CME and Shanghai are desperately trying to avoid. This is why we are seeing coordinated margin hikes across enemy nations. They need to shake out longs before delivery demands expose the entire fractional reserve system. And look at your screen. It is working. Gold 4,500, silver 72. Longs are being exterminated. But here is the smoking gun. The evidence that tells you this crash is not real. This crash is manufactured. Pull up 2 prices right now. Do it while you watch this video. COMEX silver. The paper price, the price you see on CNBC. The price on your trading app. $72 right now. Falling. Now look up Shanghai silver, the physical price. The price where actual metal changes hands. Where industrial buyers pay for silver, they actually take possession of. $100. Same metal, same day, same planet, $20 difference. Paper silver in New York is trading at $72. Physical silver in Shanghai is trading at $100. That is a 39% premium for physical over paper. If silver was really worth $72, why would anyone in Shanghai pay $100? Why would sophisticated Chinese manufacturers, people who need this metal for solar panels, for electronics, for industrial production, pay 39% more than they have to? They would not, unless they know something. They know the paper price is fake. They know $72 is a manipulated number. They know the real value of silver, the value determined by actual supply and actual demand for actual metal, is closer to what they are paying, $100. And here is what should really bake your noodle. The gap is not closing. Friday, the gap was $25. Monday, it widened to $30. Today, even as COMEX crashes harder, even as paper silver collapses, the gap is still $28. Shanghai is not crashing with New York. Physical is holding while paper collapses. Think about what that means. If this was a real crash, a crash driven by actual supply and demand, by actual sellers who actually own actual metal, both markets would be falling together. Paper and physical would move in lockstep. They are not. Paper is in free fall. Physical is holding steady. That tells you everything. The paper price is being pushed down artificially. The physical price is reflecting reality. One of these prices is a lie. And I think you know which one. Now let me tell you what is happening to the people caught in this, because the numbers do not capture the human cost. This morning, when markets opened, thousands of traders tried to sell their silver positions. Orders rejected. Circuit breaker triggered. Friday's crash was so severe that today's prices are still below the circuit limit. The exchange will not accept sell orders at current prices. The system is frozen. People who held through the weekend hoping to exit Monday morning, they are trapped. They cannot sell at any price. They are watching their net worth evaporate minute by minute while the exit door is locked shut. In China, it is even worse. The UBS SDIC Silver Fund was completely halted. Not slowed, not restricted. Halted. Entire trading session. 0 trades executed. No buying, no selling, nothing. Imagine watching silver crash 30% and being completely unable to sell. Clicking the button and nothing happening. Refreshing the page, still nothing. Calling customer service and getting hold music while your retirement account vanishes. That is what happened to thousands of investors. Not a hypothetical. Real people. Real money. Real devastation. In the US, ProShares Ultra Silver dropped 62% in a single session. If you had $100,000 Thursday night, you had $38,000 Friday evening. 62% of your wealth gone in one trading day. But the price drops were not even the worst part. Traders tried to exit, orders rejected, platforms showing error messages, systems overloaded, customer service phone lines with 2-hour wait times. And when you finally got through, they told you there was nothing they could do. One trader messaged me saying he tried to close his futures position for 18 hours straight. Every single order rejected. Watching his account drain dollar by dollar, thousand by thousand, with absolutely no ability to stop it. As of last night, some traders were still reporting account access issues. Days later, still unable to see their balances, still unable to execute trades, still locked out. They crashed the price. Then they blocked the exits. Then they raised margins again. Crash, lock, raise. If you were designing a system to transfer wealth from retail traders to institutional shorts, this is exactly how you would build it. And it is not just traders getting hurt. This crash is destroying businesses around the world. In India, in the jewelry trading hub of Rajkot, 47 firms have declared bankruptcy in the last 2 weeks, $425 million in losses. Families who have been in the silver trade for generations, wiped out in days. In London, 2 hedge funds have suspended redemptions. They cannot give investors their money back because their positions are underwater and they cannot sell. In Dubai, physical silver premiums have spiked to 18% over spot. Dealers cannot get enough metal to meet demand. The physical market is screaming shortage while the paper market screams crash. This is not a correction. This is a coordinated attack creating wreckage across the entire global financial system. Now here is what makes this crash truly insane. The fundamentals have not changed, not one bit. Silver has been in supply deficit for 5 consecutive years. There's not enough silver being mined to meet demand. Every year the world consumes more silver than it produces. Solar panels need silver. Every single one. EVs need silver. AI chips need silver. iPhones need silver. Medical devices need silver. Industrial applications are exploding. The cumulative shortfall since 2019 is 1.3 billion ounces. 18 months of global production. Consumed. Gone. And then China locked the door. January 1st, 2026, silver was added to China's strategic materials list. Export licenses now required. Volumes down 40% immediately. China refines 65% of the world's silver. They just told the West to find another supplier. There is no other supplier. Not at these volumes, not at these prices. So let me connect the dots for you. 5-year supply deficit. Exploding industrial demand. China restricting exports. Vault inventories at 20-year lows. Paper to physical ratio at 356 to 1. And the price is crashing. That only makes sense if paper is being manipulated down. If the crash is manufactured. If exchanges are coordinating to trigger forced liquidation. Before March, delivery demands expose the whole system. That is exactly what is happening. And the data proves it. So what happens next? Where does this crash end? Nobody can tell you exactly where the bottom is. Anyone claiming certainty is lying. I'm not going to give you price targets because in a crash like this, targets are meaningless. Support levels that should hold are breaking like glass. What I can tell you is what to watch for. Not price levels, something more important. The indicators that tell you whether this is ending or getting worse. Number 1, the Shanghai premium. Currently $28 over COMEX. This is the truth teller. This is the gap between what paper says silver is worth and what physical buyers are actually paying. If this gap widens to $40 or $50, paper is losing all credibility. If it narrows because physical starts dropping, the manipulation thesis might be wrong. But if it narrows because paper rises to meet physical, that is when you know the game is changing. Watch this gap. It tells you everything. Number 2, COMEX vault levels. Every Friday they release the data. Last week, 33 million ounces walked out. If this week another 20 or 30 million leaves, the vault will be nearly empty before March. Who is taking this metal? Where is it going? Why are institutions paying for trucks and security to move physical silver while the price is crashing? They know something. Number 3, lease rates. Currently 8 to 10%. Normal is 0.5%. This is what institutions pay to borrow physical silver. When lease rates spike like this, it means physical metal is hard to find. The last 2 times lease rates hit these levels were 1980 and 2011. Both times, something big happened shortly after. Number 4, March open interest. How many contracts are still open for March delivery? If traders are capitulating and closing positions, open interest drops. If traders are holding despite the pain, open interest stays elevated. High open interest going into first notice day means delivery pressure. That is exactly what the exchanges are trying to avoid. Number 5, system stress. Trading halts, platform freezes, account lockouts, error messages. If more funds get halted, if more platforms freeze, if more traders report being locked out, that tells you the system is breaking. Functioning markets do not freeze. Stressed markets do. Track these 5 indicators: Shanghai premium, vault levels, lease rates, March open interest, system stress. The data tells you what is happening before anyone else figures it out. Here's what I want you to understand about what you are watching right now. This crash is not random. It is not normal market behavior. It is not just profit taking after a big rally. 8 margin hikes in 8 weeks, unprecedented. CME and Shanghai coordinating on the same day. Enemies moving together. A $28 gap between paper and physical. Divergence that should not exist in an efficient market. Vaults draining at 26% per week. Smart money running for physical. Traders locked out of accounts, unable to exit. Businesses bankrupted. Hedge funds frozen. Physical premiums spiking globally. This is not a correction. This is a coordinated attack on long positions, designed to shake them out before March delivery demands expose the fractional reserve nature of the entire paper metals market. And it is working. The attack is working. Longs are being destroyed right now, this minute. Gold, 4,500. Silver, 72. If more funds get halted, if more platforms freeze, if more traders report being locked out, that tells you the system is breaking. Functioning markets do not freeze. Stressed markets do. Track these 5 indicators: Shanghai premium, vault levels, lease rates, March open interest, system stress. The data tells you what is happening before anyone else figures it out. Here's what I want you to understand about what you are watching right now. This crash is not random. It is not normal market behavior. It is not just profit taking after a big rally. 8 margin hikes in 8 weeks, unprecedented. CME and Shanghai coordinating on the same day. Enemies moving together. A $28 gap between paper and physical. Divergence that should not exist in an efficient market. Vaults draining at 26% per week. Smart money running for physical. Traders locked out of accounts, unable to exit. Businesses bankrupted. Hedge funds frozen. Physical premiums spiking globally. This is not a correction. This is a coordinated attack on long positions, designed to shake them out before March delivery demands expose the fractional reserve nature of the entire paper metals market. And it is working. The attack is working. Longs are being destroyed right now, this minute. Gold, 4,500. Silver, 72 video gave you the complete picture. Gold at $4,500. Silver at 70 Tao. Shanghai at $100. The gap cannot stay this wide forever. When it closes, someone will have bought at the bottom. Someone will have held through the pain. Someone will have seen what others missed. That could be you. Drop your thoughts in the comments about this crash. Share this with someone who needs to see it. Subscribe. I'm covering this daily until it breaks. See you tomorrow.